Hi, I'm Jared Nelson from the Investing Channel, and welcome to Markets and Minds, the show where we break down big macro themes into simplified trade ideas. This week we are looking at an equity index that was the driving force behind last year's record-breaking rally among U.S. stocks. Stocks that dipped briefly into a bear market in the wake of COVID-19 and the economic shutdown, but which then rallied at a breakneck pace, erasing their losses before ultimately moving on to new highs. We are, of course, talking about the Nasdaq 100 index. The index, which came into being at the end of January 1985 and was composed of 102 stocks drawn from the ranks of industrial, technology, retail, telecommunication, biotechnology, healthcare, transportation, media, and service companies. These days, the index is synonymous with technology and growth stocks, though there is a smattering of what we might call old economy names in its ranks, such as PepsiCo, Walgreen Boots Alliance, and Kraft Heinz. In terms of performance, over the last 52 weeks, the Nasdaq has rallied by more than 50%, and having touched a low of 8,886.77 on May 14, 2020, it rallied to an all-time high of 14,067 on the 29th of April this year. However, if we dig a bit deeper, we find that the index has struggled in 2021, and in fact, over the last 3 months, the benchmark has made gains of just 0.85%. The Nasdaq has been running out of steam or losing momentum this year. One way to measure the declining momentum in an index is to look at the number of times it has recently made new highs and then compare that to the data from other time frames. As we see in this chart, Nasdaq 100 has made 27 new highs over the prior 6 months, but has seen just 9 new highs in the last quarter, only 6 in the last month, and just 1 in the last week. Of course, an equity index, even one packed full of growth companies, can't keep climbing indefinitely, so some kind of slowdown was to be expected. But because the Nasdaq was effectively the talisman for one of the strongest bull markets seen in modern times, a loss of momentum could be a concern because, as the song has it, what goes up must come down. So, just what's behind the Nasdaq apparent slowdown? Well, there are several factors at play, one of which can be seen in this chart, which tracks the percentage of Nasdaq stocks above key moving averages, ranging from 5 to 200 days. The percentage of stocks within the Nasdaq that are above these moving averages has been declining in all but the 5-day cohort. A sure sign that stocks are not appreciating as quickly as they were, and in some cases are even declining in value. If we lift the hood of the index and look underneath, we find that 38 of the constituent stocks are down year to date, and that the average loss in that period among those 38 stocks is just over 9%. The largest year-to-date drop is to be found in Peloton, which has dropped by 44.76%. In total, there are 12 Nasdaq stocks that have posted double-digit losses in 2021. We can also see what the perspective of some of the smartest money on Wall Street is on the Nasdaq right now by looking at the Commitment of Traders report. This report is published weekly by the CFTC and records the positioning of various groups of traders in major futures contracts. In its most recent publication, the COT report showed that hedge funds had extended their short positions in Nasdaq futures by 116.60% to a 5-week high, and they are now net short of 16,800 contracts in the index. What's more, just a few weeks ago, QQQ, the ETF that tracks the performance of the Nasdaq index, saw its biggest outflows since the dot-com bust, with more than $6 billion leaving the fund over a 5-day period. On their own, and even in combination, none of these things are damning for the Nasdaq, or even predictive of its future direction. However, they should make us stop and question just what would happen to the wider market if the Nasdaq should not only slow down, but actually go into retreat, and how our portfolios would react to that eventuality. The image of a rubber band snapping back, having been stretched to breaking point, comes to mind. Such corrections can often happen without warning, so now might be a good time to think about spring cleaning your holdings and locking in some profits. That's all we have time for this week. Please make sure you do your own due diligence before making any investment decisions.